And so I think that's at least one explanation for why the actual interest rate hikes, and especially the guidance, the forward guidance that shows the next hike and the next hike and the next hike, is causing people to front run the hikes by buying calls, selling puts, and pushing the market upwards. But I think that what happened in early September, when the Fed virtually paused, basically kind of signaled that they're pausing, at least for now, and there's no clear expectation for more hikes coming this year, then the immediate reaction of the market was downward. And so there is an established theory called the financial accelerator that was put by Bernanke and others. And that theory says that basically what accelerates the entry into a recession when the interest rate increases is a downward spiral in stock prices or asset prices in general, and that accelerates the recession. And so my theory says that the decelerator kind of interfered with the action of the accelerator, but once there is no more expectation for hikes, the decelerator is in a pause and the accelerator is back in action again.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Amir Goren, who's a principal at the Economic Defense Fund. So, Amir, thanks so much for coming on the podcast today.
Thank you for having me.
No problem. And I'm looking forward to talking because, yeah, you emailed me and it was a really interesting, I guess, theory that you have, which I'm sure we'll get into later in the conversation. But my first question is, what are you currently seeing in the economy and the markets? Because, yeah, I guess they really haven't acted as many people expected they would have a year ago when the Fed started increasing interest rates.
Right, right. I think that, many people, including myself, expected the recession much earlier this year, and including the stock market. The stock market went down for most of 2022 based on the expectations for higher interest rates. But then starting in about October 2022 and until August of this year, there was a huge rally in the stock market. And that kind of raised some questions and challenged some existing economic theories. And my own theory about what delayed the recession was the massive release of oil from the Strategic Petroleum Reserve. I think that this was similar to a stimulus, basically giving people a significant discount on both gasoline and electricity and production costs, transportation costs for businesses. So I think that helped delay the recession, but it ended in June. And since then, the price of oil spiked. So I think that kind of kicking the can down the road is behind us now. And the question is what's going to happen with the price of oil going forward. I have some theories and we can talk about that. But the other thing that happened that has to be explained is the bounce in the stock market, the very long bounce in the stock market from October to August. And that's where my financial decelerator theory comes into play, basically explaining that the actual expectations of interest rate hikes cause call options to appreciate and put options to depreciate. And then what happens if that more people buy calls than sell them, and if more people sell puts than buy them, then basically the market makers end up being short calls and long puts, which forces them to hedge by buying the underlying assets, by buying stocks, basically. And as a result of that, the stock prices rise. And so I think that's at least one explanation for why the actual interest rate hikes, and especially the guidance, the forward guidance that shows the next hike and the next hike and the next hike, is causing people to front run the hikes by buying calls, selling puts, and pushing the market upwards. But I think that what happened in early September, when the Fed virtually paused, basically kind of signaled that they're pausing, at least for now, and there's no clear expectation for more hikes coming this year, then the immediate reaction of the market was downward. And so there is an established theory called the financial accelerator that was put by Bernanke and others. And that theory says that basically what accelerates the entry into a recession when the interest rate increases is a downward spiral in stock prices or asset prices in general, and that accelerates the recession. And so my theory says that the decelerator kind of interfered with the action of the accelerator, but once there is no more expectation for hikes, the decelerator is in a pause and the accelerator is back in action again. And one of the ways that I can see that is through high yield bonds. And those kind of stayed in a very, very tight range for a very long time, since about October of last year, kind of consolidated. And then last month, they broke down and basically signal a credit crunch and starting to signal opening of the credit spreads. So that gives me more confidence that this downward trajectory that we've been seeing with stock prices is going to stay with us for a while.
Okay, yeah, and it's really interesting. It's like, as you said, a bit counterintuitive, I guess, to what the traditional economists would expect interest rates, the impact that they would have on the markets. So would it be, let's say, I know there's been talk of a 25 basis point increase in the US potentially in the coming months. What, maybe one more for until the end of the year. But if they don't increase, and if the Fed just continues to stay paused where they are, does that mean that's going to you expect to see further downside, or does that actually have to be like a reduction in interest rates?
No, it's enough that there's no clear expectation. So right now, I would say that it's already in play because I don't think that there's a clear expectation right now. Some of the people in the FOMC believe that the rate is high enough. Some believe that they think another 25 basis points is in order, but there's no clear guidance on whether they are or not going to hike. So the decelerator works on when you have a clear expectation for another hike. That's when people can safely bet that call options are going to appreciate and put options are going to depreciate. And right now, I don't see a strong enough guidance to support that. So I think the decelerator is kind of in a pause at this point, and the accelerator, which basically works on the level. So the decelerator works on the change in interest rate, while the accelerator works on the level of interest rate. And since the level of interest rate is already much higher than it was a year ago, then I think that we have a lot of room to correct. And I think that in addition to the interest rates that are kind of tightening the economy, we also have the oil price, which is causing inflation on one hand, and that causes the Fed to be very careful when they come to a decrease rate. And on the other hand, it is also tightening by itself because it increases the costs and draining the purses of consumers, puts pressure on the margins of businesses through costs of electricity, energy, transportation, and so on. So I see, some negative forces that are operating on the economy, and I see that, in other places in the world are already in a recession, and there's another. I think that a further oil shock is still possible. So I think we're in a very sensitive moment from the standpoint of oil prices. because of the brewing agreement between Saudi Arabia, Israel, and the US. I think that if it fails, there's a risk for a war with Iran, and that might spike oil prices even further, making things even worse. On the other hand, if there is a deal, then and a war can be avoided, then I think that Saudi Arabia could agree as part of the deal to increase production and loosen up the supply of oil to reduce the price.
Yeah, so a lot of it has to do with oil. But then I guess the challenge is that if the price continues to go up, that would mean, even though it would permeate throughout the economy, you'd imagine that inflation would go up as well. So that maybe the Fed actually have to stay higher for longer, potentially,
Exactly.
rather than pivoting. So if we see higher oil prices, then what we might see the stock market remain where it is for longer, and we might not see this correction.
No, I think that if oil prices go up, it will crash the economy simultaneously with the stock market. Typically, the stock market crashes first, and that's kind of the financial accelerator that kind of puts things in motion. But in that case, if there is an oil shock, that will be a very negative development for the economy. And Chair Powell actually mentioned that in the last press conference. So I think that's something on everybody's mind. And it's unclear whether the U.S. is going to go for the deal or not. I mean, they were sounding kind of positive last week, a little bit more negative this week. So I'm not sure, where things are headed. But I know that from Israel's perspective, a nuclear Iran is kind of a big deal, right? So the Iranians recently sent away the IAEA inspectors, and so there's no way really to know what's going on there, to what level they enrich, and so on. So I think that's it won't be acceptable for a long while. So I think a decision on that front would come, in the next couple of months. And so a deal or no deal with Saudi Arabia, whether the US is willing to offer protection to Saudi Arabia against Iranian attacks, which is what the Saudi Arabians are asking for. And that's going to be, I think, a key determining point regarding the price of oil and the speediness of the recession. If they can reduce oil prices now, I believe that they will do everything possible to avoid a recession in an election year. Obviously, it's not very good politically. So if they can reduce the oil prices by making some kind of a deal with Saudi Arabia, then that may delay the recession even further.
Yeah, and I guess if we look at, yeah, as you said, if it goes to a recession and if there's higher unemployment, then that's probably what's going to influence the Fed as well as, recession dragging inflation. But
Yeah.
I guess recently we've seen, just today, I think we saw very high employment numbers in the latest data. So it doesn't look like we're seeing sort of the higher prices go throughout or having an effect yet.
Yeah, I think that there's going to be a little difference. First of all, regarding the numbers of today, the government jobs, the unadjusted numbers, were almost 1 million, I think, of government jobs. So I think that a lot of the uptick in new jobs is actually government jobs. So it doesn't really tell you much about the economy per se, right? So that's one caveat that we should take into consideration. But generally, there's been a change in the population ratio between the working force and the rest of the population, right? Because of a lot of retirements of the baby boomers. So there's a shift, there's much more non-working older people, and there's a smaller number of people who are working who needs to support a larger cohort of people. So that's very inflationary, right? You have less supply force and more demand force, and so that's inflationary, and that could keep pressure on jobs from that could keep the jobs tight, and even if there is a recession. So I'm not sure that the Fed will be at haste and would be pressured as hard as in previous recessions, because unemployment might not jump far like in recent recessions. So that can be another reason for higher for longer, along with other. I think long term there are many reasons for inflation to kind of return. One of them is what's called just in case. The transition, the deglobalization, the transition from just in time to just in case. There is the structural population shift that we talked about. And then down the line, there is the transition from the US dollar to a more global reserve currency, which I think many countries are looking forward to, including the US, by the way. I think some economists in the US realize that it's not just advantages. There are also disadvantages for the US economy in having the reserve currency, because basically the US is exporting, the main good that the US exports is US dollars. And then it imports everything else, and that kills the industry. It basically exports out all the jobs, all the industries, and so on. So that's kind of a side effect of being the reserve currency. And so I'm not sure that it's such a good deal as many people believe that it is. But obviously, going off the reserve currency, taking the reserve currency status from the US dollar would depreciate it a lot over time. That would be a major inflationary force in the US. And so that's another force that the Fed would have to reckon with.
Yeah, so that's probably the longer term. But you were saying sort of before that with because the labor market might be stronger potentially than previous recessions, that could be positive. That like in terms of them not having to um, pivot, and then if oil prices go high, then that's another reason for them not to decrease interest rates. So I guess from your perspective,
Right.
what would influence them to then have to decrease interest rates? Because I guess they don't want to be like um, previous of power doesn't want to be like previous chair feds who, just pivoted when the economy was going great, inflation was down, and we saw this massive bubble forming.
Yeah. Yeah, I think that if we see a prolonged recession, which I think is very probable. So at least from my indicators, I see something like a 4-quarter recession at this point, and I don't see the bottom yet. So it may continue to go south, but for now, I see 4 quarters of a recession, and so at some point, not initially, but maybe a year from now or a year from the beginning of the recession, we will see the effect on unemployment as well. So I think only at the end of the recession, when the unemployment rate starts to show problems in the workforce, and at the same time we see less inflationary pressures because of the recession, which will also take time to relieve the pressure from inflation. I think that only then they would start reducing rates, and probably very carefully, probably very gradually. And that actually brings me to another prediction that my theory makes. It basically makes two predictions. One seems to be holding pretty well, which was the pause, what happens when there's a pause. And I predicted despite of the seemingly good news that there's no more hiking, the stock market will start another bear decline. The second prediction is what happens if they decrease the rates gradually, if they give guidance for lower and lower rates, and then the decelerator actually reverses a direction and actually pushes stock prices down. So despite reducing rates, what the theory predicts is that stocks will actually go even lower because of these rate reductions. And only when they stop reducing rates, only when they reach a permanent lower level, that's when we'll see the positive effect of a lower rate. So that's kind of the second prediction.
Okay. Yeah, it's fascinating thing. So before we get on to the impacts it will have on the markets, if we go back to your thoughts on the recession, you're saying it could be for 4 quarters and then potentially longer. How would that compare to, I guess, previous recessions, as well as is that just going to be a broad, a long recession, or could it be very deep and painful as well?
So a lot of people are using the terminology of hard and soft landing, and I'm not sure that I know what exactly that means. How to distinguish between those. So I think that from an unemployment perspective, I kind of already said what I think. It's not going to be as hard as previous recessions. But from a length perspective, I think it's going to be a fairly long recession because, for example, in 2022, we had 2 quarters of negative growth, right? And from the indicators, I was able to forecast it about a year in advance, and I could see that there are 2 weak quarters coming in. The same indicator is right now showing 4 quarters of weaker economic conditions, and other indications like other indicators like the conference board leading indicator and so on also show that we are in a recession territory. So I think the only kind of description that I can provide is really the length of the recession. I don't think that it's going to be kind of a quick and over dip. I think it's going to be a prolonged, difficult time, and even more so for the stock market.
Yeah, it sounds like that would be worse for markets then. As you said, if there's a short, sharp dip, then we see a probably similar to COVID, we'll see that quick drop and then like a fast rebound. But through this um, longer recession, then it's going to be more painful longer, and then we'll see the up.
Yeah, I think one thing we didn't discuss is the whole QE versus QT kind of a deal. And I think the Fed at this point realized that QE was really a bad idea. And all it did, it didn't help the economy. It didn't help Main Street at all. All it did is help Wall Street. And those were the people who were responsible for the financial crisis in 2007 in the first place. So instead of them paying the price, Main Street ended up paying the price, and they got bailed out by QE, and that caused a lot of inequality. And in addition, it created kind of a bad incentive, right, to not take into consider not paying for your own mistakes and so forth. So I think that they realized that QE was a mistake, and that's why they are so determined to continue quantitative tightening, basically reversing the effects or the damage that was put in place by quantitative easing, and they're continuing to decrease the money supply every month by $75 billion, and that's pulling liquidity out of the market. So the same force, basically QE kind of provided endless liquidity for the asset markets, pushing stocks and everything pretty much higher and higher and higher and higher, and this process is being reversed, and now they are pushing everything down. And what they did pause a little bit when there was a banking crisis back in February. So you can see that the monetary base was going down and down and down, and then there was a blip up in February, March, April, May, and now it's back down again. So I think that's another force that is going to be pushing asset prices down. And we already saw that with the treasuries that have kind of gone down and the yield going up, and with the stocks that are now on a kind of a bear trajectory.
Yeah, so I was actually going to mention that because, as you said, you mentioned at the start, let's get sort of like a liquidity crunch from for those long-ended bonds, which have depreciated quite a lot in value because of the high interest rates. So, do you see there being a risk of the that impacting the U.S. government? Because I guess if we look at their fiscal situation at the moment, it seems to be accelerating rapidly the amount that they're borrowing. So, what impact do you think it will have on the economy, or will it have an impact? Will the Fed have to come in and uh, go back to QE to sort of artificially decrease yields?
Yeah, I don't see the Fed going back to QE. I think they realized this was a completely, bad idea. I think they will use other facilities like the discount window and other facilities that actually force bad institutions to pay the price. So basically, they make sure that the stock owners lose everything, management is being replaced, and the only people that they are trying to save are the depositors and maybe the lenders. Um, so that's what I think the Fed is going to do. But what is very interesting, I think, in what you said is that the government is now in a very precarious situation, because what's happening now is the deficit that is often used to battle a recession is now actually counterproductive, because part of the reason why the yields of long-term treasuries spiked is because of the huge debt and the debt to GDP ratio, and in addition to that, the huge deficit that is compounding the debt. So what would happen if they try to increase the deficit and send checks to people again? It's not clear to me that the net effect is going to be positive, because if the bond market is going to uh, basically protest against this additional deficit, and people are going to dump even more bonds, and basically when the government is having a deficit, they have to also sell bonds. So by them selling bonds, they are also spiking the rates, and that creates pressure and tightening on the economy. So we are in a weird situation where a deficit is now tightening the economy. So that will make it very difficult for the Treasury and for the government to do something with this fiscal dominance situation.
Yeah, it's definitely interesting times. And I guess if we look at the last time there was such a fiscal deficit in World War II, the government and the Fed were working in the same direction. Whereas at the moment, it's almost as if they're pulling each other in the opposite direction. So that's really the challenge that we're seeing.
Right, right.
Yeah.
I think people were kind of questioning whether it was even legal to do QE, and basically, in a roundabout way, funding government deficits by virtually printing money. That's not supposed to happen by law, and they did it anyway. But now that they know that it really doesn't work, it really doesn't benefit anyone other than Wall Street, other than pushing asset prices up and benefiting the rich while doing nothing for the poor. It's hard for me to believe that they're going to pursue this route again. They may increase the monetary base using other means, like I mentioned, like discount window and stuff like that.
Yeah, okay, makes sense. So if we look at your, as you said, you think that the stock market is going to decrease during the whole time that the Fed sort of starts to pivot, which they already have, and reduces interest rates. So I guess where do you think that could go? Or are you just really looking at the Fed and sort of their what they're looking at, or how far do you think the market could drop?
So if the Fed, again, the oil thing I think is the key. If they don't manage to push oil down, then I think that the beginning of a recession should be this quarter or even the previous quarter. And obviously, we will know this only in retrospect, maybe a year from now. But that is where I think the beginning of the recession would be, about now, maybe a little earlier, maybe a little later. And I think the stock market should probably continue going down until they finish lowering rates. Uh, that's uh, that's the signal that I would be looking for to enter long and close my massive short positions.
And how do you know if it's an actual pivot or if it's just because I guess on the way up they stopped and then increased as well? What is it
So,
more just looking at their predictions and what they're saying, what they're
yeah, what I'm
communicating?
looking for is not a finality, but the end of expectation. So as long as there's a clear expectation for a lower rate and a lower rate and a lower rate, I wouldn't bet on the bear market to finish. Once there's uncertainty and it's not clear whether it's going to stay like that, maybe they will reduce more. I think that if I look at previous reductions, they start very carefully because they're not sure how bad the situation is. They're not sure. So they start lowering gradually, and it did make things worse in previous cases. But then they panic and they slash it in one fell swoop, and they go to the minimum. So that's what I would be looking for is when they slash, maybe they won't slash to a zero this time, maybe they slash to two, I don't know. But once they do this big cut and say, okay, we're not giving any more guidance to gradual rate reductions, that's going to be the time to go long, I think.
Okay. And do you think that would be, I'm guessing, would it be the opposite for bonds or
So bonds, I'm completely
not very?
at
Okay.
loss. There are so many things that, on one hand, this should happen. On the other hand, the other thing should happen in the short term, in the long term, in the midterm. So I'm not touching any of that.
Yeah. Okay. Makes sense. So, Amir, thanks so much for coming on today. I really appreciate it. My last question is, what is one message you want people to take away from our conversation?
Be conservative, keep your powder dry, and be ready for some roller coaster ride.
Yeah, it definitely sounds like it. So, thanks again for your time. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
You can find me at economicdefensefund.com, and I also have a newsletter which is called Economic Defense on the Substack platform.
Yeah, perfect. I'll put that all in the description below. But thanks again for your time.
Thank you.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.